Hello and welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by 𝗖𝗵𝗽𝗀 Sun Life Mutual Fund and Value Research. Now, in a hot market like the one we are experiencing right now, it's easy to get swept up in the euphoria. So, in such a time, what should you do? Let's discuss that with Dhirendra Kumar. Welcome, Dhirendra.
Thank you.
You know, at Value Research, we're getting a lot of questions since the market is going only up. So investors are fearful of a correction. So are the markets poised for a correction?
First and foremost, we have been expecting the correction for last 4 years. Even at the peak of COVID, the market went down and after that it rebounded in just a month's time. And then it has not stopped. The stock market's level is basically an aggregate of the underlying company's ability to generate returns. And I don't think there is anything alarming there. There will be pockets of market which might look very expensive. But mind you, I don't see anything in this environment, in the ecosystem, which is saying that the market must come down because the SIP money is is still rising. Besides the SIP money, the PF money is also rising. NPS money is also steadily rising. NPS, the money that comes every month, and that is primarily from private sector employees, that gets invested into top 200 companies. It's like a wholesale SIP. The money, the way it is pouring in, unless you have some calamity which looks like a calamity and a lot of people get scared, something which will impair the earnings capability of the companies in the country, and that will be a surprise. That is something which we can't anticipate. Besides that, internationally, the interest rates have, in the US, the interest rate has come down. If interest rate has come down, foreign investors were pulling out, there is a likelihood that they will start investing again. And India remains, all the positive things about the India story is still on the forefront. We are beginning to emerge as a manufacturing country as well. Companies beginning to gain prominence in manufacturing as well. I don't see any big reason why the market will come down. Just because the market has gone up and gone up substantially and a part of the market looks very expensive. And there's a possibility that in 1 or 2 quarters, if market just remains the way it is and, goes up a little bit, comes down a little bit, I think, if earnings go up, markets will start looking cheap again. Market has gone up does not necessarily mean that markets will come down. And that is something which investors have to start thinking. But still, it could be disappointing for many investors even if it comes down temporarily. More so for investors who came in the market in the last 2-3 years. They haven't seen a declining phase. And I think there is need for little preparedness for that. The first level of preparedness for old investor, new investor is that invest your long-term money. Because if you invest your short-term money, then any good investment, bad investment, you will realize that, okay, you need the money after 8 months and you have invested in equity and that has gone down about 20%. So that will unnerve you. Make sure that it is the money which you are unlikely to need for at least 2-3 years, even if you have been investing for many years. Second is that, you are not taking a big, exposure at one go. Even if you have 10 lakh rupees to invest and, make sure that you are spreading it over 4-5 months, 6 months at least, simply because, of course, it requires a little more thought in terms of how that 10 lakh rupees, how important in your context. But more importantly, the moment, you invest 10 lakh rupees, market goes down, it becomes a great deal of anxiety. And there's a greater likelihood that you will take your losses and run. And that is a very undesirable situation. Third is that, we keep telling at Value Research that do your asset allocation. Do your asset allocation when you have something to lose, when you have something meaningful. But most investors in a market, the kind of market we have seen, a balanced view will be that at least have 20% into fixed income. If you are a very conservative investor, have 50% into fixed income. Even if you are a long-term moderate investor, but you have, accumulated something very sizable, make sure that you have 1/3 of your money invested in fixed income so that the market comes down, you'll be able to capitalize on that. Market keeps going up, you will be substantially rising. And also, 1/3 invested in fixed income or 20% or 50% is not going to be a zero return thing. That can also, yield modest return, half as much as equity in the long run. So, but it will provide you the much needed stability. And more so for any investor who has come in the market, and in the last 5 years, a lot of investors have come in the market for the first time through mutual fund. For them, the people who still have 30 years and they are still doing their SIP, though they don't need to do anything. Till you have accumulated something, don't worry. But if you have something meaningful accumulated, it's like buying an insurance, which means that you will give up on some part of your return, but it is worth it.
Okay. So in a hot market, how can mutual fund investors ensure that they're not chasing short-term performance and are actually looking at long-term fundamentals? How to ensure that?
No, you don't have much of a say in what kind of companies the fund manager is invested in. There are 2-3 ways of doing it. One is to avoid those funds, because most investors just do a sorting on value research online, look at what has done very well in recent times, and they start investing in that. And that is why we witness that many investors put money in sector funds or thematic funds, because they do exceptionally well in a brief period of time. And they may not, and the fact that they have done well generally translates into they doing very poorly soon after. So don't get attracted to it. Diversification is the mantra here. Second is that if you are investing in such, diversification at 2 levels. A fund which is investing across everything, not just large cap, not just mid cap, not just small cap, an all cap fund. Second is that there is a need for a style diversification. There are funds which invest in growth stocks. There are funds which invest in value stocks. There are most small cap funds, they end up being aggressive growth funds, stocks, because it's very difficult to find the value style in small cap universe. So mixing it up well, making sure that you are taking a holistic view in your portfolio. If you have a couple of growth funds, make sure that 1/3 of your money, 20% of your money is in value fund as well, because that will provide you the cushion. That will also provide you, because different segment of the market is cyclical. So when your high growth funds will stop doing well, this is when this will start doing well from there on. So it will be a great balancing thing for you. And it is very difficult to perfectly time the cyclicality of anything. If you do this much of precaution, this much of preparation, I don't think you'll be disappointed.
All right. Apart from this preparation, are there any red flags that one should be, cautious about?
You can't anticipate any of those red flags. When you are in the middle of a market frenzy, and when some of those red flags will be staring at you, but you will get as many opinions that this is not a red flag. Rightly so. When I see the red flags around us many times, time has taken care of it. Those red flags did not really turn out to be a red flag, or it looked like a false red flag. But if you do these things, if you do all the things that I was listing, diversification, long-term orientation, diversification by style, asset allocation, those red flags won't matter.
Okay, and hypothetically, if the market cools down, if a correction does happen, how can investors ensure that their portfolios are resilient in that phase of?
Diversification. And only if you have that long-term orientation, because diversification in isolation will not help you save you.
Okay. All right, now moving on to the viewer's question. Archit says, my investments in equity mutual funds are more than 1 year old, thus qualify for long-term capital gains. I have approximately 35% appreciation in my investments. Keeping in view the high market valuations, is it advisable to book partial profits by way of shifting 50% of my corpus to balanced equity funds?
One is that, congratulations, Archit. Your money is up 35%, which is quite meaningful. Second is that, if you have any plan to spend this money, if you are investing for a goal, by all means take your money out. But just because it has gone up is not a good enough reason for you to sell. The only other reason why you should sell is that your fund is a bad one. This year, the average equity fund is up 28%. 2 years ago, the market was up 25%. Last year, the market was, average equity fund was up about 3 to 4%. So if you look at these returns, 3% was not so disappointing if you had captured the 25%. And 3% would have been very disappointing if you were coming from a negative year or a year in which funds generated no return or you lost money. These things cannot be anticipated. But I don't see that there is any reason for you to pull your money out. The problem is that if you take your money out, half your money out, 35% of half your money will be subject to taxation. It will be liable for long-term capital gains, which is also 12.5%. They take your money out and 12.5% of your gains will be gone. So you actually reduce your capital if you don't have a plan.
All right. Hope, Archit, you got your answer there. That's all we have for you in today's episode. Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Take care. Bye for now.